Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
Paul Winkler, Evan Barnard, Dan Hill, talking money and investing. All right, so one of the things that one of our pet peeves, any kind of commission-based products, pet peeve around here. Pet peeve, we hate this stuff. Just because, you get so much misleading, so much information that's just misinformation when it comes to investing in commission-based products. There's a lot of misinformation out there, and every chance I get, I really try to pick on this stuff. But there's a lot of misinformation even in the investing world when it comes to non-commission-based investments. Now, one of the things that there is out there is this idea of how much should you have in stocks versus bonds in retirement. And you can say, well, how do we choose how much to have in the stock markets versus fixed income markets? There was an article, we'll probably get to it today at some point, that Americans are actually getting at record levels in stocks. And they're doing it because the market has been up and they chase returns. After markets go up, people like to invest in the stock market. When markets go down, they tend to run away from markets. Now, forever, there has been this age-old thing about how much to have in stocks versus bonds that was put forth by John Bogle, who was a founder of Vanguard. And Bogle would talk about the rule of 100. And I was watching a video where this guy is talking about how to use annuities in your investment portfolio as a supplement, or not a supplement, as a replacement for bonds in the portfolio. So basically, here's how he started his video. This guy, best-selling author, he's got this all these accolades about how great his program is. But in essence, this guy is trying to sell something that I would heartily disagree with. But I want to talk to you as to why and walk you through why we want to disagree with this.
Retirees approach retirement. They often shift a portion of their retirement savings to bonds because they're considered safer than stocks. A common financial industry principle known as the rule of 100 helps pre-retirees and retirees strike the right stock-bond balance. It works like this. Take your age, subtract from 100, and that tells you what percentage of your portfolio you should have in stocks. The rest goes into bonds. For example, if you're 60 years old, you should have 40% of your portfolio in stocks and 60% in bonds. The reason retirees adopt this approach is because historically stocks and bonds have been inversely correlated. As stocks go up, bonds go down, and vice versa. This helps smooth out volatility at a period in your life when you can least afford to lose money in retirement.
Go ahead, Evan. He's shaking his head. His head's about to fall off going, what?
Yeah, there's really no truth to this. They're negatively correlated.
It's slightly negatively correlated with intermediate bonds, slightly negatively correlated, but it's actually closer to non-correlated.
Correct.
So I knew why you were shaking your head.
They could go up at the same time. They could go opposite directions. They could go down. Yeah. I mean, they're really non-correlated.
They really are. And so what happens is sometimes when you have big market downturns, bonds can actually go up in value, which would give him the idea to say that they're negatively correlated. But the reality of it is most of the time when stock markets go up, so do bonds. They just don't go up as much. Yeah. So it's really it's very, very misleading, number one. Number two, this whole idea of the rule of 100 is really bad, because if you look at, let's say you go over the past 25 years and you were to take an income of, let's say, and I've done this before on videos, and I've done this with workshops where I took an income from an investment portfolio and I increased it for inflation each year, saying, hey, what would have happened? How much income could I have taken? What would have my end account value be at the end of it all? So if I got $1 million portfolio and I take 40,000 out, and now it takes about 80,000 to buy what 40,000 used to buy. That's inflation over the past 25 years. So cost of living has about doubled over the last 25 years. What if I had taken 40,000 out and increased it each year, and now I'm taking 80? So I would have taken about $1.3 million out over that period of time, just to give you an example. Out of $1 million portfolio, what would have happened at various asset mixes? Interestingly, the asset mix that would have had the by far highest ending account value. If you followed everything we teach on this show and all the things that we teach in our workshops, you would have had a much higher outcome with a 75% stock portfolio mixed between large, small, value, growth, international, U.S., emerging markets, and fixed income, shorter term. But what he's doing here is he's saying, no, you should have almost nothing in stocks. And you get to be 70 years old. How much do you have in stocks? 30%. You get to be 75 and you only have 25%. You're looking at that and go, how do you outpace inflation? Now, It sounds good to the risk-averse investor. But what they're doing is they're exchanging market risk for inflation risk. Yeah, Danny.
Well, just to your point right there, they're ignoring longevity.
Yes.
Which is one of the greatest risks we face nowadays.
Yeah, no question.
So I think some time ago, even before I left the dark side, we had changed that rule of 100 to 110 or 120.
Yeah.
Because of longevity. People
no, that's a good
longer.
point. Yeah, you're right.
So that's a recent commercial, right?
Yeah, that was literally this guy. I don't know when he put this video. It was fairly
the last
recently.
5 years.
Yeah, it was a video that he put out.
We went around from the rule of 100 years ago.
No, that's a really good point. That's using really old data. So that's a really good point. It's very dated. Yeah.
Not talking about what kind of bonds. Right.
Oh, I'm going to get to that. I was going to get to that, but okay, since you brought it up already, he had long-term government bonds, where you look at what he's saying, why his portfolio using his annuity would have done better. It's because he used the wrong type of bonds. But I was going to get to that, but okay, since you brought it up, yeah.
It just sounds to me like he's setting up a straw man.
Of course.
If, instead of this
That's how you sell.
crappy portfolio, get an annuity. Yeah. Like, okay. Yeah, it's better than running in traffic in the freeway. Sure. Okay. I'll take the annuity,
Yeah. Running in traffic. No, that's probably a good idea. Stay away from that. So then he gets into, and we talk about academics here. Now, I have switched over the years, over recent history, to saying more evidence-based research, because academic research, although it sounds really good, there are academics that are quite frankly compromised, in my humble opinion.
Evidence-based sounds sexier anyway.
It really does. So that's where he goes next, to give you the reason you ought to. So the idea, I have to have stocks and bonds in my portfolio, let's say. I determined that I want to have 50% of my portfolio in stocks and I want to have 50% in bonds. Well, do we use bonds or do we say, no, let's buy an index annuity and use annuities as my bond replacement? So this is what he's advocating for here, okay? Now, of course, it is an annuity salesperson, so you can understand why he's advocating for that. But how do I get people to believe that what I'm doing is really, really good for people? Well, I want to bring academics. So I borrow their credibility, is what we call that in the industry. And here's what he has to say about that, who the academics, what they have to say.
Retirement. Well, there are two renowned economists, Robert Shiller and Roger Ibbotson from Yale University, that have recently affirmed that, mathematically speaking, bonds may not be the best solution.
Now, Ibbotson, if you've ever seen a stock market chart, it's Ibbotson Associates. That's where the data comes from, going back to the 1920s. He and Rick Singfeld put that data together.
Solution when trying to manage risk and retirement. Professor Shiller analyzed 10-year returns for stocks, bonds, and a fixed indexed annuity, linked to the Shiller Barclays CAPE U.S. sector USD.
Now, the CAPE, it is cyclically adjusted PE ratios is what that stands for, just to let you know what that is. I actually refer to that in my book, Confident Investing. And one of the things that I did in my book is I took the CAPE data and I said, hey, is this helpful in telling us where the stock market's going to go? That's going to become really important in just a second. Is it helpful for telling us what's going to happen? In other words, the idea, for those of you that are nerds out there, which I believe a lot of people that listen to this show are nerds, and that's a good thing. It's a term of endearment here. If the price compared to earnings on a company is high, the price is high compared to its earnings, the future returns, and if we cyclically adjust that, we adjust it for market cycles. If we have a high price, the future returns should be lower. That's the idea. We're going to use this as a determinant of future performance. If price is high, that means that future returns should be lower, or if prices are low, that means returns should be higher in the future. And what I did in my book, is I actually took the CAPE data going back. I think I went back. I think I went back 100 years. It's been a while since I wrote the book. It's only been a couple of years. It hasn't been that long, but I slept since then.
Coming through us all.
But what I did in there is I pointed out how it was not a predictor at all. It wasn't helpful in the least bit in telling us what was going to happen in markets. But anyway, they're using the CAPE data here, and they're using it to try to figure out what we ought to do and if this is going to work. But
Index, a smart beta index that incorporated Professor Schiller's value investment philosophies. His simulations uncovered 4 startling truths.
4 startling.
First, in every 10-year period, the fixed index annuity outperformed bonds.
Okay, so he says in every period, they actually outperform bonds. So you have to ask yourself, is that really true? Did they actually do that well? There's actually some, AARP. They actually interviewed somebody that we respect around here. They interviewed. They had this thing about and let me just tell you the title of it. What is a fixed index annuity is what the title of it was. Michael Kitces basically said this. He said salespeople might claim that FIAs could earn higher returns, 6-7% per year, but with fees they struggle to match. They struggle to match the low returns from bonds. And he does something called the nerd's eye view. He is a very nerdy financial guy, teaches financial advisors all around the country. And he's very, very well thought of. High fees. You can't find out what you're paying for in the investment management. Costs are buried in the black box system used to adjust the credits to your account. Sales commissions run 5 to 7%, maybe hidden too, under the new fiduciary rule, which requires advisors to put your interest above theirs. Commissions have been disclosed if you're buying the annuity for a retirement account, but not for other accounts. This is AARP again. Salespeople sometimes claim falsely that their services are free. You don't have to pay me. The insurance company is paying me. And then, of course, you have profit limits. They cap the returns. Poor liquidity is the other issue. And when you're rebalancing an investment portfolio, you have to have liquidity. If I'm pulling income out of my portfolio and I'm using an annuity as my bond replacement, I've got a problem because I have liquidity issues. It's hard to get at it. And then you can add guaranteed income benefits, but I like what Kitces has to say about this. He says, why do it? He says, your basic FIA, fixed income index annuity, already provides lifetime income. What's more, 5% is not a return on your investment. The insurer is merely paying you your own money back. And sometimes I've heard people market that as, that you're getting this return, 5%. But anyway, he goes on.
Without taking any more risk than what you might be accustomed to taking in your savings account. Second, the long-term nature of fixed index annuities constrains irrational investment behavior. In other words, the surrender charges in the annuity actually force the investor to stay invested in the fixed index annuity, which prevented them from succumbing to emotion-driven investing decisions.
What's wrong with that, guys? I mean, when you're managing an investment portfolio and you're taking income from it, what makes that a problem? You're forced to stay in bonds?
Yeah.
Does that make sense? Something else is hitting you, Evan. Go ahead.
The phrase just didn't make sense. I mean, you can't rebalance with the annuity. I mean, that's an inherent problem, and I don't think that's what he's saying. But basically they're saying.
But that's what I'm saying.
Yeah,
yeah. That makes the problem.
Yeah,
he's not even thinking about that.
Right.
What were you thinking?
No, yeah, it was just
okay.
Just
so it doesn't make sense for that reason. Okay, so we were coming to the same conclusion. Okay, so the next thing.
Third, by providing a principal guarantee and market participation, fixed index annuities offer a unique risk-reward profile. When you link the growth of the account to the upward movement of a stock market index while guaranteeing against loss, you can actually increase the return on the portfolio, eliminate the risk, and lower the overall standard deviation of the portfolio. And fourth, in simulations,
Not
fixed
really.
index annuities returns were less correlated to the broader economy than stocks or bonds, offering a potential diversification benefit. In other words, fixed index annuities are like an asset class unto themselves. They seem to march to the beat of their own drum, which helps further diversify your portfolio.
Well, what did he just say there? He said that it's less correlated, and he just made the point previously that having negative correlation was actually the benefit. So he just contradicted himself there.
Yeah.
Yeah. Now, let's look at the professors in question here. So love Ibsen, love his data, love everything about it. But let's just face it. If we look at what he came up with, I remember being intrigued with it, his Zebra equity component index. It was a Zebra Edge index. What is it used in? It is used in the management of annuities. So right there, you have a conflict. This is often used in these products, number one. Now, how does it – go ahead.
I think it was created just for that, Paul.
Yeah,
I think he created the Zebra Edge just for the annuity companies.
Yeah, I think you may be right about that. It was the idea of using that as an index. So the insurance companies, it's right in there in the product. Now, how is it created? You have a universe of New York Stock Exchange U.S. cap equal index stocks. Okay, so it's an equal index. It's a cap. You typically have cap weighted indexes. This is equal weighted. So you're getting rid of the problem that most of your index is in just a few companies. Now, he says, what are we going to do? We're going to take that index, 500 stocks, remove the 150 most popular names, and then we're going to remove the 250 most long and short-term volatile names, and then we're going to equate the remaining names, and that's how the index is created. So that is the idea behind that index. Well, the question that you ask yourself is, how well have they done? And the answer is not very well. If you look at their return, it's somewhere in the neighborhood of about 4%, I think is what it was. Let me see if I've got that here. The actual return, it was around 4% per year versus the index. This is going from the year 2000 through the end of July. The return of the index that they removed the objectionable things from had a return of 10. So in essence, they managed to lop off about 6% per year return, which is massive.
So that stat actually makes total sense to me. As you were reading the construction of the index, I'm thinking, okay, well, right now we have like 10 stocks that comprise 40% of the market cap and probably 100% of the positive return. Mm-hmm. And we're eliminating those.
Yes, we got to eliminate all that good stuff.
Let's see here. How's this going to turn out?
How often are they reviewing that or reconstituting?
Oh, that's a good question, Danny. I don't know how often they reconstituted. I didn't see that in the data, but it was just the idea of what the return of that was. It was as of August 2025, annualized return statistics for the NYSE Zebra Edge Index. This is Ibsen's index, show an annualized return of approximately 4.69%, and as I looked at, it was around 10% for the equal weighted index. I looked at data for that, and it's abysmal. You look at that. Then you've got this whole thing with the other academic that they referred to in this, and it's Schiller, right? And you go, well, what does Schiller have to say? And he is advocating for this supposedly as well.
Yeah.
Well, I liked there was a video where they was talking about Fama versus Schiller out there, where these guys are discussing the two gentlemen. And Richard Thaler is a well-known, he's an academic who does a lot of behavioral
economy.
That's exactly, behavioral finance. You're right, Evan, exactly. And this is what they had to say about that, these two guys. It was kind of funny.
With the Schiller prediction thing, him and Richard Thaler were co-presidents of the behavioral economics group of the American Economists Association. And Thaler has very specifically slagged Schiller in terms of how bad his forecasts are. He just makes them over and over again very nicely until he's eventually right.
Yeah, there you go. So Watch out for the word academic. When somebody's talking about academic, that's why we use evidence-based a whole lot more these days.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.